I'm looking at the most significant tax revolution in decades, and almost nobody knows it exists. While Americans argue about inflation, interest rates, and political drama, there's been a complete transformation of the tax code that could put thousands of extra dollars in your pocket, or cost you thousands if you miss it. On July 4th, 2025, the One Big Beautiful Bill became law. I've spent weeks analyzing these changes, and I'm telling you right now, this isn't just another routine tax adjustment. This is the biggest restructuring of American tax policy since the Tax Cuts and Jobs Act, with implications that will reshape how millions of families approach their finances. Here's what's keeping me up at night. Most Americans have absolutely no idea these changes exist. We're heading into the 2026 tax season, and I'm watching as taxpayers are completely unprepared for opportunities that could save them $10,000, even $25,000 on their tax returns. But here's the problem. If you don't know about these changes, if you don't plan for them, if you don't structure your finances correctly, you're going to miss out entirely. Let me walk you through what really happened on July 4th, because this goes far beyond what the media reported. The One Big Beautiful Bill didn't just extend existing tax provisions. It created entirely new categories of tax-free income that most people don't even know exist. Starting with tax year 2025. If you receive tip income in qualifying occupations, you can now deduct up to $25,000 annually. That's not $25,000 in tips that get taxed at a lower rate. That's $25,000 in tip income that becomes completely tax-free. For a server, bartender, hairstylist, or delivery driver earning substantial tips, this represents savings of $3,000 to $8,000 per year, depending on your tax bracket. But here's what nobody's explaining about the tip deduction. The IRS has to determine which occupations customarily and regularly receive tips, and that list was finalized on December 31st, 2024. If you're in a tip-receiving occupation but you're not on that official list, you lose the entire deduction. Most people in eligible occupations have no idea they need to track their tip income differently starting this year. The overtime deduction is equally revolutionary and equally misunderstood. If you work overtime and receive time and a half pay, you can now deduct the half portion, the premium above your regular hourly rate. For single filers, this deduction caps at $12,500 annually. For married couples filing jointly, the cap is $25,000. But here's the critical detail most people are missing. This only applies to overtime reported on your W-2, Form 1099, or other official statements. If your overtime isn't properly documented, you lose the entire benefit. Let me give you a real-world example. Say you're a nurse working frequent overtime, earning $35 per hour regular pay and $52.50 for overtime hours. If you work 15 hours of overtime weekly, that's approximately $13,600 in overtime premium annually. Under the new law, you can deduct $12,500 of that premium, potentially saving $2,500 to $4,600 in federal taxes alone, depending on your bracket. But there's a massive problem developing that I'm seeing in my analysis. The phase-out rules for these deductions are complex and punitive. Both the tip and overtime deductions begin phasing out at $150,000 in modified adjusted gross income for single filers, $300,000 for joint filers. But the phase-out isn't gradual, it's aggressive. Many middle-class families who think they qualify will discover they've lost substantial portions of these benefits. Now let's talk about the change that could be worth more than all the others combined, the senior citizen deduction. If you're 65 or older, you now qualify for an additional $6,000 federal deduction, beyond the standard deduction. For married couples where both spouses are 65 plus, that's $12,000 in additional deductions. This isn't a credit, it's a deduction. So the actual tax savings depend on your marginal rate. But we're talking about $1,200 to $440 in annual savings for most seniors. The phase-out for the senior deduction starts at $75,000 MAGI for single filers, $150,000 for joint filers. What's particularly interesting about this provision is how it interacts with retirement planning. Many seniors are going to discover that their 401k withdrawals, Social Security benefits, and other retirement income push them into the phase-out range, eliminating much of this benefit. Here's where the strategic planning becomes crucial. The new law created something called auto loan interest deduction for qualifying vehicles. You can deduct up to $10,000 annually in interest paid on auto loans, but only for vehicles assembled in the United States weighing under 14,000 pounds. This deduction phases out starting at $100,000 MAGI for single filers. Most people think this is just about buying American cars, but there's a deeper financial planning opportunity here. If you're considering a vehicle purchase and you qualify income-wise, financing instead of paying cash could actually save you money through the tax deduction. For someone in the 24% tax bracket paying $8,000 annually in auto loan interest, this deduction saves $1,920 in federal taxes. But here's what really concerns me about the implementation of these changes. The IRS has been overwhelmed trying to update forms, create new reporting requirements, and issue guidance. They've already announced penalty relief for 2025 because they know taxpayers and even tax professionals don't understand these new rules. The reporting requirements alone are creating massive compliance burdens. Employers must now track and report tip income and overtime premiums separately. Digital asset brokers must issue Form 1099-DA for cryptocurrency transactions. The complexity is exponentially increasing, yet most Americans remain completely unaware. There's another massive change that's flying completely under the radar: the SALT deduction expansion. The state and local tax deduction limit increased from $10,000 to $40,000 for tax years 2025 through 2030. For taxpayers in high-tax states like California, New York, New Jersey, this represents enormous tax savings. But here's the political reality nobody's discussing. This $30,000 increase in the SALT cap primarily benefits high-income taxpayers in blue states. The federal government is essentially subsidizing state and local taxes for wealthy residents of high-tax jurisdictions, while taxpayers in low-tax states receive no comparable benefit. This is a massive wealth transfer mechanism disguised as tax relief. Let me break down the actual numbers on SALT expansion. A family in Westchester County, New York, paying $35,000 in state and local taxes can now deduct the full amount instead of just $10,000. In the 32% federal bracket, that additional $25,000 deduction saves $8,000 annually in federal taxes. Meanwhile, a similar family in Texas with no state income tax receives zero additional benefit from this change. The child tax credit expansion represents another significant but poorly understood change. The credit increased from $2,000 to $2,200 per qualifying child for 2025 and 2026. Additionally, $5,100 2020 of the adoption credit can now be refundable, meaning families can receive it even if they owe no federal taxes. But these expansions come with hidden costs that most families haven't considered. The federal deficit is exploding. Interest payments on national debt are approaching $1 trillion annually, and these tax cuts are adding hundreds of billions to the debt burden. The money has to come from somewhere, and that somewhere is either higher future taxes or continued currency debasement through money printing. Here's my analysis of what this means for different income groups. Lower income families benefit most from the tip deduction and expanded child credits. Middle income families see mixed results. They might save on overtime deductions and auto loan interest, but phase-outs eliminate many benefits. High-income families in expensive states win big from SALT expansion, while high-income families in low-tax states see minimal benefits. The retirement planning implications are particularly complex. The new 60-63 age group can now make enhanced catch-up contributions to 401k plans, up to $11,250 in additional contributions beyond the normal catch-up limits. Combined with the senior deduction starting at age 65, this creates a powerful tax optimization window for pre-retirees. But there's a concerning pattern emerging in my analysis. These tax changes are being implemented without corresponding spending cuts or revenue increases elsewhere. We're essentially borrowing money to fund tax cuts, adding to an already unsustainable debt burden. The long-term economic consequences could far outweigh the short-term tax benefits for most families. The compliance complexity is becoming a major issue that will hit taxpayers hard in 2026. The IRS estimates that average preparation time for individual returns will increase by 2 to 3 hours due to these new provisions. Tax software companies are scrambling to update their programs. Many tax preparers don't fully understand the new rules yet. There's also the Trump savings account provision that's getting zero attention. Starting in 2026, the federal government will make a one-time $1,000 contribution to special accounts for babies born between 2026 and 2028. Parents can contribute up to $5,000 annually. Employers can add $2,500, and the accounts grow tax-deferred until age. While this sounds generous, the fiscal cost is enormous, potentially $3 to $4 billion annually in direct government spending, plus lost tax revenue on the tax-deferred growth. The enhanced retirement contribution limits represent another major change. For 2025, IRA contribution limits increased to $7,000 with $1,000 catch-up for those 50 plus. But the big change is for workers aged 60 to 63, who can now make catch-up contributions of up to $11,025 to their 401k plans, significantly higher than the standard $7,500 catch-up. This creates a massive tax planning opportunity for late career workers, but only if they understand the new rules. Here's what I'm telling clients about positioning for these changes. First, maximize eligible deductions by ensuring proper documentation. If you receive tips or overtime, verify that your employer is reporting these correctly and separately. Second, consider the interaction effects between different provisions and phase-outs. Third, plan major financial decisions like vehicle purchases around the new deduction opportunities. The education benefits also saw significant expansion. The 529 plan rules now allow up to $20,000 annually to be used for K-12 expenses, up from previous limits. College students can use 529 funds for additional qualified expenses under the expanded definitions. For families with children, this represents substantial additional flexibility in education funding. But most importantly, understand that these are temporary provisions in many cases. The tip and overtime deductions sunset after 2028. The senior deduction expires after 2028. The enhanced auto loan deduction ends after 2028. Congress designed these as temporary stimulus measures, not permanent tax reform. The political implications are fascinating and concerning. These changes primarily benefit middle and lower income voters, while adding substantially to federal debt. It's essentially vote buying through the tax code, funded by borrowing that future generations will have to repay. Here's what's really troubling me about the fiscal mathematics. The Joint Committee on Taxation estimates these provisions will cost $450 billion in lost revenue over the 4-year period. That's in addition to the existing $2 trillion annual deficits we're already running. We're literally borrowing money from future taxpayers to provide current tax relief. Looking ahead to 2026, I'm predicting chaos during tax season. Taxpayers will discover benefits they never knew existed, alongside phase-outs they didn't understand. The IRS will be overwhelmed with questions about provisions they're still figuring out themselves. Professional tax preparation fees will increase significantly due to added complexity. The cryptocurrency reporting requirements alone will create massive headaches. For the first time, digital asset brokers must issue Form 1099-DA for crypto transactions. Most crypto investors have no idea this is coming, and many won't receive the forms until well into tax season. This will delay millions of returns and create compliance nightmares. What's particularly concerning about the crypto reporting is how it interacts with the existing tax complexity. Many crypto investors have been using the specific identification method for calculating gains and losses, but the new 1099-DA forms may not align with their record keeping. This could force investors to reconcile significant discrepancies between their calculations and official broker reporting. The estate tax provisions also saw major adjustments that wealthy families need to understand immediately. The basic exclusion amount increased to $15 million per individual for 2026, up from $13.9 million in 2025. For married couples, this means $30 million in combined estate tax exemption. But here's what estate planners are missing. This increase is happening alongside other provisions that could trigger unexpected tax events for high net worth families. There's also a lesser-known provision affecting health savings accounts and flexible spending arrangements. The HSA contribution limits increased, but more importantly, the new law expanded what qualifies as eligible medical expenses. This creates opportunities for tax-free reimbursement of expenses that weren't previously covered. The employer-provided childcare credit represents another massive opportunity that most business owners don't know about. The maximum credit increased from $150,000 annually, with eligible small businesses able to claim up to $600,000. For businesses considering childcare benefits, this change makes such programs significantly more attractive from a tax perspective. My recommendation is to start planning now. Review your 2025 income sources and structure to maximize available deductions. Consider whether major financial decisions like home purchases, vehicle financing, or retirement distributions should be timed around these new provisions. Most importantly, work with a qualified tax professional who understands these changes. Not all preparers are adequately trained on the new law. The interaction effects between different provisions create both opportunities and traps that most people won't recognize until it's too late. For example, the phase-outs for various deductions don't all occur at the same income levels, creating cliff effects where small increases in income can eliminate multiple benefits simultaneously. Consider a married couple earning $295,000 in modified adjusted gross income. They're just under the $300,000 phase-out threshold for tip and overtime deductions. But if their income increases to $305,000, Perhaps through a bonus, stock option exercise, or additional consulting income, they could lose tip deductions, overtime deductions, and see reductions in other phase-out sensitive benefits. The compliance burden extends beyond individual taxpayers to small businesses and employers. Companies must now track and report overtime premiums separately from regular wages. They must identify which employees work in tip-eligible occupations. They must issue additional forms and statements. Many small business owners are completely unaware of these new requirements and could face penalties for non-compliance. There's also the issue of retroactive planning opportunities that most people are missing. Because the law became effective for tax year 2025, families can still make financial decisions in late 2025 that maximize benefits under the new rules. This includes timing of vehicle purchases to qualify for auto loan interest deductions, restructuring compensation to maximize tip or overtime premium benefits, and accelerating or deferring income to optimize phase-out effects. These tax changes represent a fundamental shift in how our government approaches fiscal policy using the tax code for social engineering rather than pure revenue generation. The bottom line is this: the One Big Beautiful Bill created the most significant tax planning opportunities in decades, but only for taxpayers who understand and properly utilize the new provisions. The cost of missing these opportunities could be tens of thousands of dollars over the next few years. The cost of the underlying fiscal irresponsibility that funds these tax cuts could be far greater in the long run.